In today's episode, I'm going to walk you through how to use Bollinger Bands to help predict when the price is going to reverse. Bollinger Bands are a technical indicator that you can put on your charts, and since they're an indicator, they're part of the universal language of the financial markets, that is technical analysis. What that means is that when a Bollinger Band communicates a buy or a sell signal, there are so many other traders that are seeing that same signal and responding to it that, in a sense, it becomes a self-fulfilling prophecy. So there's a very clear correlation between a buy and sell signal with the Bollinger Bands and then seeing the price react. So traders who get really good at recognizing these signals are going to have an edge against other traders in the market, and you're the traders who are going to get really good at predicting where the price is going to go next. Clearly, the traders who can predict the future the best will be the ones who are the most consistent in the long run. Now, it doesn't matter whether you're trading stocks, Forex, futures, you're trading cryptocurrency, you can apply Bollinger Bands to any financial instrument where you can pull up a chart. So we're going to go over some stocks that I was watching today, and we'll look at one of them that I actually traded. And I'll help you break down where the Bollinger Bands give you an edge. Okay, so we're going to start by looking at CTMX here. This is just a stock that is up today about 200% on breaking news, which is pretty impressive. And you can see we got this move up here, we got a little pullback, we got another move higher, we got a dip, and then notice this false breakout right here. What you'll see is that the price popped up and then it rejected and reversed back down. Now, this was somewhat predictable, both because of Bollinger Bands and a couple of other indicators that I'm going to show you right now. So this is the chart without Bollinger Bands on it. And now I want to pop the Bollinger Bands on to show you how different it looks. So we're going to go over here to this indicator. I'm going to search for Bollinger Bands, and I'm going to pop it on right here. Now, when I put on Bollinger Bands, the settings that I use are the standard settings. I don't edit them in any way. Here's the problem with editing your Bollinger Band settings. If you change them from what everyone else is using, you're going to see different buy and sell signals. So if you said, oh, I really want to use a length of 37 and a multiple of 3.5, you're totally changing the way the indicator looks on your chart. And now anything that you see is going to be totally different from what other people see. So my recommendation is to keep it exactly standard. And I do the same thing with all of my indicators, whether it's MACD or it's RSI. I just keep the settings totally standard because I want to make sure that I'm seeing the same things that other people are seeing. Okay, so when we look at this now, let's pull up the full screen 5-minute chart. Here's what I look at. Whenever I see a candle that is fully outside the Bollinger Bands, I expect a reversal is coming soon. It is an indicator of a reversal. It is not a guarantee that we will get a reversal, but it is a high likelihood that we will. So what that looks like is this candle right here. This candle is fully outside the Bollinger Bands. So this blue band here is the top of the Bollinger Bands. This is the bottom of the Bollinger Bands right here. And the Bollinger Bands, depending on your settings, may also have an average line that's going to be down the center. So you'll have the median line right here. You see how it's in orange? So this is the average between the two Bollinger Bands right in the middle. And then you have the upper band and you have the lower band. Now, what some people would do is they would change the color on this and change the gradient to make it either more difficult to see the price action inside the Bollinger Bands or less difficult. I think it's fine to leave it, again, really this is as you'd like. This is more of a visual display. But making it a little bit more contrast, I think is helpful for one important reason. I like to be focusing on stocks that are either, at the moment, riding the top of the Bollinger Bands right here or are outside the Bollinger Bands, because this is when the price action gets the most interesting. When the price comes back within the Bollinger Bands, as it is here, this is often when we see the stock is going to be choppier, we're not going to see clean moves, and you're more likely to get caught into false breakouts. So the indicator that I look at, number one, is price outside Bollinger Bands. If the price is outside the Bollinger Bands, either to the upside or the downside, there's a high likelihood that we will reverse soon. It's just, the fact is, nearly 95% of the price action during the day will occur inside the Bollinger Bands. So as you see, this is all the price action that's occurring inside the Bollinger Bands here, right? We're inside. So it's a very limited period of time when you're outside, and stocks don't remain irrational like this for a long time. Now, there's a saying that they can remain irrational longer than you can remain solvent. So just because the price is starting to break outside the top of the Bollinger Bands doesn't mean you should sell or go short. It just means that we are getting extended, and the likelihood and the probability of a retracement and a reversal is now increasing. So as we have this candle right here that has the red topping tail, it's a red topping tail with this upper candle wick. It's a bit of a doji with this sort of spinning top body right here. It's just a very small body. The confirmation is then when the next candle breaks the low, and your stop is always at the high of day. So if you had exited this position, which you would have been holding, let's say, to the long side, if you had gotten in down here for the red to green move, a proper exit would have been the first candle that made the new low, which is right here. Now, it did hold for a few minutes, and it did make another attempt back up, but it ended up being a dramatic reversal. This, to me, was predictable that this would be a reversal because this consolidation was occurring outside the Bollinger Bands and well above the support of the 9 exponential moving average. Those of you guys, so reversal indicators, those of you guys who know the way that I trade, I like to focus on stocks that are near the 9 EMA, and I like to focus on trading when the MACD is open or when it's above the signal line. And I'll show you that here in just a moment as well. So let's go ahead and add MACD to this time frame. We're looking at a 5-minute chart right now, but you can use Bollinger Bands really on any time frame. The 1 minute and the 5 minute are both appropriate. So MACD I primarily use on the 1 minute, but I'll show this to you in any case on the 5 minute. All right, so we're going to go back to full screen here. And what you're going to see is that in this period, at the beginning of the move, the MACD is open. So the MACD is above the signal line, which is this orange line here. We come back down a little bit and we come back up. So based on the MACD, this was open for trading basically from here until here. The only problem is you could see right here, this is sort of right when the MACD was curling against the trade, and then we get that crossover right at this big rejection candle. So one of the things that is important is using your indicators to help you rule out whether or not you should take a trade. So on a position like this, if I was watching this consolidation right in this area, this is what I would say. I would say, well, we've got a couple problems here. Number one, we've got the price, which is outside the Bollinger Bands, which means it's extended, and we've got a higher likelihood of a reversal. Number two, the price is well extended off of the 9 moving average, which increases the likelihood of a false breakout. And number three, the MACD is starting to curl against the trade. And number four, volume profile shows high volume selling candles, both at the open and on this topping tail candle right here. For those reasons, it would be too risky to take a new position right here. And then, of course, as you can see, the result was that we ended up getting this this break where it popped up, reversed, and came back down. And from that point forward, this is no longer something I would be interested in trading. Now, some people would have taken this as a short position with a stop at the high, and that's perfectly reasonable. Stop is at the high. That's your logical stop right there. You're shorting based on the price being extended outside the Bollinger Bands, extended off the 9 EMA, and the MACD approaching a crossover. The point to cover this position usually is going to be when it comes first down to the 9 EMA, then down to the 20 EMA, and then down to the volume weighted average price. We eventually make our way to the midpoint of the Bollinger Bands in this orange line, but it takes a little bit longer to do that. Now, here we are later in the day. The Bollinger Bands have become very compressed. They're very close together, and the price is trading in a fairly narrow range. This can sometimes lead to an expansion where the price will pull away. So it wouldn't entirely shock me if that started to happen. However, from a technical perspective, a couple issues we have would be the high of this pivot back here at 522 that we need to cross, and then the high of this rejection candle right here. So if we can get over 522 and hold that level, Then the next stop is 568, and then we're back to the high of 587. And that's when we would then look for that secondary move to the upside, which would be through power hour. What you have going for you on this one right now is that the MACD is now crossed into the positive, but you also have the problem of declining volume as we have come later into the trading session. So this is an analysis of CTMX using Bollinger Bands. Now we're going to switch and look at PALI. PALI is actually the stock that I traded this morning, which also had breaking news. Now, what's interesting about PALI is we got this initial squeeze right here on breaking news. And then what ended up happening was it basically stalled out. So we got a surge higher. The MACD was certainly open as it surged higher. We had a nice big green volume bar, but then the following candle was red, pulled back, and is fully outside the Bollinger Bands. That's a high likelihood of a reversal. It ends up coming back down, and as you can see, it pulls all the way back down to that 9 exponential moving average. It then comes down to the 20 moving average and eventually makes its way down to the midpoint. So this is again on a 5-minute time frame, but you can see how clear it is that those candles were outside the Bollinger Bands. Now, if we look at this on over the course of the day, you can see again how in this area, the Bollinger Bands became very compressed, and then that led to a sell-off back down. So the range became very, very narrow, and then we broke to the downside, which in this case was fairly predictable that if we were going to break one way or the other, we would break to the downside because the price was below the volume-weighted average price. It was really weak. It wasn't holding up well. Overall, the stock was showing weakness. The MACD at this time right here was actually, it was positive, and then it broke to the downside. But being below the volume-weighted average price was really our problem. So both of these have been a review on the 5-minute chart. So now what I'm going to do is I'm going to switch this to the 1-minute chart. So on the 1-minute chart, I'm going to go ahead and add Bollinger Bands right here. The times that I was using Bollinger Bands the most in my career is when I was predominantly trading reversals. When I was trading reversals, I really wanted to pay super close attention to those candles outside the Bollinger Bands to help me get a good indication if we were going to have a reversal. So right here, we have the initial pop-up. So we have this initial push right here. We have a little bit of a 2-candle pullback, and then we push higher. Now, this is the spot right here where if we had a candle that had made a new low right down here, this could have been our reversal indicator right away because that candle was fully outside the Bollinger Bands. But remember, this is a caution flag. It's not the indicator to sell or go short immediately. What you're looking for is the confirmation, which is the next candle to make a new low. And we didn't get that. This candle held, and then this one broke the high of this level, and so the bull run continues. It pushes a little higher, pushes a little higher, pushes a little higher, continuing to ride the top of the Bollinger Band. But because we're at the top of the Bollinger Band, we can clearly tell that the price is really extended. We end up having a small little doji right here, and then the first candle to make a new low is this red candle. And at that point, it's never able to get back to high a day. From that point on for the rest of the day. So right there, that first candle making a new low as an indicator to sell or go short, depending on your strategy, that obviously pulled back down to the 9 moving average, then it pulled to the 20, and it just kept retracing. If we switch back to CTMX, let's see. We'll look at this one on the 1-minute chart. This one shows a couple of interesting moments. Right here, this was the most notable. When we got this extension, we got this push higher. And you'll notice how sometimes the Bollinger Bands will compress and then they quickly pull away, as it did right here. It sort of compresses and then it pulls away. So the Bollinger Bands are moving on both sides as we're having heightened volatility. Now, at the beginning of this move, let's see, back here, we were riding the top of the Bollinger Band. We pulled back, but we more or less went sideways. We finally got a candle that made a new low, but by that point, we were already at the support of the 9 moving average, so that's not really a good short because you're too close to support. It ends up grinding a little higher, pulling back, coming up again, pulling back a little bit more, selling off, and then doing this red to green move. So we get the red to green move, And all of a sudden from here, it's back to the top of the Bollinger Bands. Top of the Bollinger Band, a short-term reversal here, back down to the 9 moving average, sideways, sideways, and then a spike back up, sideways, sideways, and now it starts to really punch higher. Little micro pullback, it pushes even higher, even higher. Now we're up outside the Bollinger Bands, and this gives way to a bigger reversal right here, coming back down. Support at the 9 moving average, then support down here around the 20. All right. So, this is the, these are a couple examples of reversals where we were looking at the move to the top side. SMCI, this is one that gave us a move to the downside. So let's look at this one for a second. Okay, so this is an after-hours sell-off here. So first, you have this massive moment of volatility. Way above the top of the Bollinger Bands right here, the price squeezes up, way above it, and then a rapid reversal all the way to the bottom. Outside the Bollinger Band, and a retracement back up. So it's like these Bollinger Bands, think of them as rubber bands. And when they're really stretched out, when the price is at those extremes, it's increasing the probability that we're going to have to snap back. And when we snap back, our target is about volume weighted average price. But naturally, because we've got a couple of other indicators coming up to us in the way, we first look at the 9, the 20, and then we look at the VWAP. So I'm going to get my drawing tools out here. So we've got the Bollinger Bands right here. We've got the volume weighted average price somewhere in the middle, usually something like that. We've got, if the price is up on the upper side, we've got the 9 moving average up here, and then we would have the 20 right in here, just for instance. So when the price is up here, our first target when we're getting a reversal would be support at the 9, then support at the 20, and then support at volume weighted average price. If we were trading below, so let's see. So this isn't going to be exactly perfect, but we'll just do it anyways. So if we were below like this, the price was down here, we'd been selling off. So we had a candle where we dipped below the bottom. Then we're looking for that bounce back up here. First level of support at the 9, resistance, second level of resistance at the 20, and then ultimate target back to VWAP. And VWAP right here, that's when the rubber band is basically slack. That's when you're back to the equilibrium point for the day. So here on SMCI, we end up seeing the price come back to equilibrium and then roll over again. And it starts to go lower, and it goes lower and lower. And you see these dojis, this type of doji here down there, that is like a classic reversal indicator. Classic reversal indicator. Doji at the extension of the move. Because what this is communicating, the doji candle is communicating the battle between buyers and sellers, right? The price opens, it spikes up, it dips down, and then it bounces back and closes like that. So it's a tug of war. And when you have this in the context of just having had a long period of selling off, there was very clear market sentiment. It was weak, a ton of weakness. Now right here, it's showing a sign of strength. The fact that there was enough strength for it to rally off the low and come back up here, and even to bounce up here, this is showing that some strength is coming into this candle. So a doji is a candle of indecision. When you have a doji candle that occurs when the price is outside of the Bollinger Bands, that is amplifying the likelihood that we're going to see this reversal. And the reversal is, of course, we're going to come back to the 9, the 20, and the VWAP. Now, increasing the likelihood of the reversal is when we're extended off our 9 EMA and when the MACD is closed or closing. Either one, closed or closing, is going to increase the likelihood of that reversal back in. Now, in my day-to-day trading, I have gotten to a point where I can pretty well visualize whether or not the price is outside the Bollinger Bands without actually having them plotted on my chart, because I can just recognize that the stock is extended. So when I see an extended chart, I see that we've got this like really big move, we're really stretched out. I'm already thinking the price is outside the Bollinger Bands without needing it on there. Now, getting to the point where you can visualize that without having the indicator is going to take some time. And similarly, if we look at CTMX, If we look back at CTMX, traders who have been in the market for a long time will there we go, it's starting to pull away. Traders who have been in the market for a long time will start to recognize a pivot like this one here at 522. And you may not need to draw it because you just are able to visualize, oh, it's right there, so that's going to be an issue. We're going to run into that. But as a beginner trader, it's a great idea to draw these trend lines because they're going to help you just better visualize the price action and better understand areas where we might see possible levels of resistance. So, if that's one, maybe, something like that, something in that area. So then as this moves forward, you would say, all right, well, when it comes back down here, I'm going to look for this bounce off this ascending support line. So the more experience you have, the more second nature it becomes to be able to visualize and predict when the price is outside the Bollinger Bands. And actually, just as it broke there, we got up outside the Bollinger Bands. And then again, because of this issue with this resistance here at 522 and the time of the day, the volume on this candle right here is a fraction of the volume we saw earlier in the day. So if we're really going to make it all the way back up to this level, presumably we would need more or less that same amount of volume. But that's not likely to happen when you've got 15 to 20 minutes to the closing bell, right? Because it's now later in the afternoon. So this is a higher likelihood of a false breakout, right? Price is outside the Bollinger Bands, the volume, it's a little light, and you've got some resistance coming back up here. One thing that I would caution is adding too many indicators to your charts, because if you add too many indicators, you can fall into this pattern of analysis paralysis, right? Your charts just start to get so busy that it's hard to really see the woods through the trees, so to speak. And if we go in here, you can see all of these different indicators that you could add. And when you start adding a lot of these, your charts can get really, really messy. So when I'm thinking about some of the most essential, some of the most valuable indicators, these are the ones that I'm thinking about. And I'll give you a little list right here. So Bollinger Bands, so we'll say, and this isn't in any particular order. So Bollinger Bands, MACD, RSI, Relative Strength Index, EMAs, and SMAs, moving averages. So moving averages and exponential moving averages and volume weighted average price. These are probably the most essential that you're going to see on most charts. Now, some traders are going to start searching for the holy grail, and some of you know exactly what I'm talking about. You're searching for an indicator that will give you 100% accuracy, so you'll never lose money. But let's get real. Trading carries risk, and you will have losses. Even the most successful traders lose all the time. I have over $12 million of gross profit, and I'm wrong 30% of the time, almost 32% of the time. So you don't have to be right all the time, but you have to get good at cutting your losses, and you want to make sure that, generally speaking, your winners are bigger than your losers. Using technical indicators can help give you an edge because they help you better understand what type of setup is A quality and which ones are like B or C quality. So when you're looking at your indicators, these help either confirm or sort of deny whether or not the setup is valid. So in the case of a CTMX right here, it wouldn't have been hard for me to talk myself out of this trade based on the position of these indicators. However, if you have 25 indicators that you have to review every time before you take a trade, you're going to start getting conflicting signals. You're going to get analysis paralysis, and you may find yourself talking yourself out of too many trades and missing what could have been some really solid opportunities. Now, if you want to learn more about technical analysis, I will put a link down below, pinned to the top of the description and in the comments, where you can download my ultimate technical analysis PDF. It's a document that you can download, you can print it out, you can have it next to your trading station, and it's going to walk you through all of the indicators that I like, and it's going to break down several candlestick chart patterns that I rely on in my own trading. So if you found this episode interesting, I hope you hit that thumbs up, and I hope you subscribe to the channel for more episodes about trading strategy just like this.